Nope. 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 That's the sound in the face that some people are going to be making, those silly chickens out there using payment for order flow when they realize that the apes understand what's actually happening here. Oh my gosh, guys, I couldn't sleep last night. I think I laid down at like 7 or so, and I got up at like 9. I was like, screw it, whatever. So I just stayed up and I pieced through some research and some stuff that I kind of want to put together here for payment for order flow. Fast forward to now, it's 6:30 in the morning, and I'm finally kind of done with this whole presentation in terms of information, the background, the history, synopsis on payment for order flow, so you guys can walk away a little bit better off and hopefully understand the process better if you did not know it before. But before we get into that, what is up, everybody? Welcome to Trace Trades, where we freaking talk fast and don't skip class. I like to preface by saying that I'm not a financial advisor or expert, so take what I say with a grain of salt. Let's get into this bad boy. So as you can see here by the title of the video, we're going to be talking about payment for order flow. The origin of how this came to be is actually a little bit sad. It's disgusting. And the reasoning that I say that is because the man who came up with payment for order flow is Bernard Madoff. Now, if you're not familiar with him, we'll give you a brief synopsis, but I do encourage you look him up for more details in terms of what actually happened here. But Bernie Madoff got busted for a really gnarly billions of dollars worth of Ponzi scheme, and he also created a hedge fund. So we're gonna start here in chronological order and kind of walk you through this whole process. So 1960, Bernard L. Madoff created Investment Securities LLC. The actual origin of what he was trying to do, I don't think in and of itself was malicious, right? He had an intention essentially that he wanted to make money. He didn't start with a lot of cash. He started with about $5,000 to get things rolling. In his intentions, I like to think, but money talks, and people can lose themselves at money, right? That's where I think true character is tested, is where you really see people show up to the plate, right? Is when there's money on the line. So essentially what he did, he was a penny stock broker dealer. He was essentially in charge of, bids and asks and getting things filled. So that brings me to 1971. His job initially was to make markets, which is essentially just a quote, bid and ask prices. And to make this, pretty simple for you, these guys, these market makers essentially make profit on the difference between the bid and the ask, which you can essentially think of as where people are willing to sell it at, where people are willing to buy it at. They make the difference in profit. So that was his job. It'd be something similar to like a lit market, the New York Stock Exchange or the NASDAQ, which we're actually going to get into here in a little bit. This is actually fascinating, and it just makes you wonder about the whole system and the way that things were built. But nonetheless, markets literally and economically demanded a better product. He couldn't compete with the New York Stock Exchange firms, right? And to put this in a pretty simple sort of context, think about Bernie Madoff LLC. His whole sort of, securities LLC that he created, it was just too small, right? The product that they were offering, even if it was good, can't compete with the top line stuff, which at the time was the New York Stock Exchange. New York Stock Exchange still obviously being one of the best out there. So what do you do in this situation? Think of it like an apple versus a firefly. I don't know if you guys remember what the firefly looked like, but this is actually the first phone that I ever had. And it's going to blow your mind looking at this sucker. Let me just pull this up. So it'd be like the Firefly phone trying to compete with an Apple. It'd be very, very difficult. You'd have to create a product that's literally just different from what currently exists because of the market supremacy and the brand name that's carried by Apple. In the same way, Bernie Madoff had to create something better than what presently existed at the time, which was in-person trading, right? Paper trading. There are actual certificates of stocks that are being exchanged on any given day. It would take you a long time to get orders filled. So what did he do? He couldn't compete with the market, so he created tech that was better than the market. But what was the better tech? And that became essentially two main things: electronic trading, which is what we use nowadays, right? As well as OTC exchanges, over-the-counter exchanges. Now, this is really important to think about because this is going to lead us to payment for order flow. This is not payment for order flow, but it's going to lead us to payment for order flow and how this is actually important. The purpose and appeal of OTC exchanges and trading is that there's no exchange regulator, there's less transparency, you can execute block trades, and there's lower bid and ask spreads, right? So what's the appeal to both parties here, to the market maker as well as to the people who are getting their orders filled? Well, lower bid and ask spreads means that you have a better chance of walking away profitable on any sort of trade, right? Think if you were to buy a stock at $10, but you want to sell it at $10.50, and there's a huge spread between the bid and the ask, and you got to give it to a buyer, right? The bid, you got to slap that thing in order to sell it. It means that the stock has to go up 50 cents for you just to break even if there's a 50-cent spread. So there's an appeal to that, but there's also a money appeal. It's very profitable for market makers to be able to utilize this sort of tool. So having known this now, that's the purpose and appeal is money, less transparency, big block trades, no exchange, regulator, supervision. Just right off the bat. What does that tell you? It tells you that there's some people that wanted to do things with their money that they didn't want to show to the general public. And Bernie Madoff helped create that. So Bernie Madoff's firm evolved into market making or profiting off of the bid and ask spreads on OTC trading. Now, in and of itself, that's not malicious, right? That's just something that market makers do. That's how they make their money. They want to find the most opportunity to make cash, whatever. Let it be what it is. Let's put this into perspective, though, because this is going to come into importance as we get further into the video. Madoff Securities was the largest market maker at the NASDAQ, and Madoff Securities was also the 6th largest market maker in the S&P 500 stocks. Now, this is important because these guys, that means that a lot of the volume that was being traded across the entire stock market, right? The New York Stock Exchange, you include Madoff Securities in here, they took a large chunk of that overall liquidity in the market space, which means they can move markets in any given direction if they wanted to do so. Bernie found the best way to consistently return money in the market, which was to profit off of people's trades. In this scenario, which sounds goofy, but this is the most simple way I can put it, you're the product, right? They make money off of your trading. That's how he found ways to consistently be profitable. And this is going to bring us to payment for order flow. I just want to give you this whole background so that you can understand truly how freaking crazy this whole situation is, right? So now let's talk about payment for order flow, because now when we put into perspective how these guys usually make money, the way that things normally work in a stock market, you've got essentially OTC trading, lit exchanges, which are the New York Stock Exchange, the NASDAQ, at the time, Madoff Securities, whatever it may be. They make money on the bids and asks, the spreads. Payment for order flow is a little bit different. You've got monetary kickback to brokers to fill orders at a third party. Now, think about this logically, right? If there's a third party out there, a firm such as Madoff Securities, who invented payment for order flow, why would they be willing to pay a broker to have orders executed at their specific firm? It's because they make fucking money on it. I mean, that's as simple as it gets. If you're willing to pay somebody $5 to go in and freaking mow your lawn, right? Maybe it's because you run a lawn mowing business. Maybe it's because they're the product. Maybe it's because that's how you're making your freaking cash. That's exactly what happened here, right? Now, the purpose and appeal of payment for order flow, let's walk through this before I kind of get into why this is really not a good thing in this situation. So the purpose and appeal of payment for order flow is investors execute a buy and a sell order. The brokerage will then route that order to a third party, which in this instance was Madoff Securities. Broker collects kickback for routing that order, and then third party finds the best execution, which has some asterisks assigned. Best execution can be interpreted in a couple different ways. Maybe it means you get the best fill. Maybe it means you've got the most timely execution. Maybe it means you're providing liquidity for the market space. These are all assuming massive conflict of interest, right? This is an actually really important topic to be able to dive into, is that conflict of interest. And this is going to be important for this piece, as well as what I'm going to talk about in the current market situation. Now, why do I think there's massive conflict of interest here? And why do I think payment for order flow in and of itself, on top of the Ponzi scheme that this dude literally created, is problematic, right? So we're going to walk you through that. But first, I want to talk about his Ponzi scheme, because you have to understand this to be able to truly understand why this doesn't make sense. Hold up. You have to understand what this Ponzi scheme is. So what happened with Madoff, right? Bernie Madoff. What he did was essentially build a pyramid setup where he would tell investors, hey, you give me money and I'll guarantee you X amount of returns annually, and we're just going to keep that rocking. And people were making cash. People were making freaking fat, filthy stacks. But the reason for that was because he was paying people through other investors' money. Essentially, you had an infinite feedback loop of investors that were feeding other investors returns. So an investor right here would put in money, right? Bam, looking good. Another investor would put in money. What he would do is he would take this investor's money and he would actually feed it into the previous investor's pockets. And that endless feedback loop would continue forever and ever and ever and ever. But wait a second, right? He also is in charge of OTC trading. He's also in charge of payment for order flow, which both provide monetary kickback to them, to the original firm, right? This is not good. This is not good because this is vested interest, conflict of interest. He built this system with the intention of fraudulence. He built this Ponzi scheme with the intention of fraudulence. Now, I can't speak on the fact of whether the payment for order flow was correlated with his Ponzi scheme and OTC trading, right? All this sort of stuff. But what I can say is that it's very similar to a situation that you're watching unravel in real time right now. So what he did is he promised investors extraordinarily high returns. He took that money from investors and deposited it into his bank. He paid the returns to investors with other investors' money, rinsed and repeated until literally failure. Now, this conflict of interest, this is the last piece I want to talk about before we can actually get into where this is problematic in today's time and age. Bernie pioneered payment for order flow in order to route orders to a third party, which was at the time his firm. Why, though? Think about this. This is the really goofy part. Bernie pioneered payment for order flow in order to route orders to a third party, which was at the time his firm. He was a market maker. He was a market maker as well as a firm. Very similar to another company that we're going to talk about in a little bit here. The bid and the ask spread profits, that's not malicious in the least bit, right? That's just business. They're making money, whatever it may be. But misconduct of orders, if the third party has vested interest, that's problematic. And this is going to bring us back to this piece right here. Check this out. Bernie Madoff's firm evolved into market making or profiting off of bid and ask spreads on OTC trading. Ask yourself a question. What firm out there is this reminding you of right now? Like, you can't make this shit up. You really can't. You can't make this up. It just gets better. It just gets better. Hold on a sec. Bernie also created the largest Ponzi scheme in U.S. history, which could have been aided by payment for order flow. Payment for order flow profits could have very easily been feeding into the malicious and fraudulent activity that he was committing to. And don't think for a second that could not happen now, that it couldn't, god dang it, that it didn't happen in the past, that it won't happen again, right? It's absolutely 100% possible. Payment for order flow offered Bernie additional trade execution money while also committing to financial treason in the realm of billions of dollars. And Bernie's scheme was shut down, but what about payment for order flow, right? But let's just think about this logically. If you knew that the guy who pioneered payment for order flow, who pioneered the electronic system that's actually utilized literally now by the NASDAQ, you probably want to look into exactly the system that he built, wouldn't you? Well, this is the argument. This is the argument for the benefit of payment for order flow. It allows commission-free trading for retail investors. Sure, that's not wrong. It's a true statement. It saves the retail investor money on paper, right? It also allows for better liquidity and efficiency within the market. But at what cost, right? This is the important piece. Think about this in real life scenarios. Anytime that you are offered a free service, it is because you are the product. Facebook, YouTube, Google, payment for order flow, all of these things, they're free to you because they make money off of you. And it gets worse than this, my friends. And God, it just feels like a freaking morbid story that I even have to tell. But the problem with payment for order flow is that it's literally embedded in the entire stock market and it's unavoidable. You can't avoid it. And I'm going to show you exactly why that's the case. So check this out. What does this actually mean? What does this do? What does payment for order flow and the whole process actually look like? You've got brokers and third parties. So initially it starts out like this. You've got a retail investor who has a buy and a sell order that they want to get executed. They send that to their broker. This said broker goes to a third party who they have some sort of agreement with and say, hey, look, we have this payment for order flow agreement. I'm going to sell you this buy and or sell order, and you're going to give me a monetary kickback. The broker really isn't doing anything wrong here, right? They're just trying to make money. Initially, in and of itself, they're not market makers, right? They don't get to choose where orders get filled, how they get sold, how they get bought. They don't get to choose what the firm does with those orders. It's essentially just best execution. That's the guidelines that these guys have to follow by legally. So the third party, i.e. a market maker and or a firm, goes and fills that buy and or sell order. Now, where can they do this? They can do it in a million spots because that's the problem with literally now's day and age in the stock market is you can go to the lit exchange, right? The New York Stock Exchange, the NASDAQ, etc. You can go OTC, over-the-counter market. You can go to dark pools. You can go to their own actual personal securities portfolio. Literally their own, like I'm not making this shit up, their own personal securities portfolio. These big market makers and firms have their own portfolios of different securities in the market to help liquidity and help things keep moving. I don't know about you, but that doesn't sound like supply and demand. That doesn't sound right at all. And when this is filled, the order execution goes back to the retail investor, and then all is said and done. So if the brokers are getting paid for every single transaction that takes place because they're getting paid by these third parties, we're going to get into this more, but you already know where I'm going with this. How much money do you think these guys are making, right? Why pay for trade execution? It's not only if the retail investors not only are the retail investors the product, but brokers are too. This leads us to somehow legal monopoly Citadel Securities. Now, I'm not here to freaking start some claim of fraudulence or a scam, but I am going to tell you this. The picture that you see lined up in front of you is eerily similar to what you've seen in the past with Madoff Securities. I'm just telling you. You guys connect the dots yourself, but I literally could not go to sleep reading through this stuff for the last 8 hours. So check this out. Let's talk money, because this is important, right? This is a concept that's talked about a lot by retail investors as of late. All the apes out there, basically debating how payment for order flow works and how this actually affects the broad scheme of the way the market operates. Brokers in 2020 and in the first half of 2021 received this much kickback from payment for order flow, meaning that the people who are paying these guys out, the big firms and market makers that want to use payment for order flow, paid out a total of $2.604 billion in 2020. And in 2021, the first half alone, $1.819 billion. In the market, it's considered to follow the smart money. It's smart to do that, right? So where big amounts of money move, let's do that. Let's see where the money's going. Where's this coming from? Well, truth be told, and how would you know it, Citadel paid out the majority of that capital. $1.08 billion of that 2.6, Citadel. $760 million of the $1.81 billion, Citadel. That's 41% of all payment for order flow kickback. So now you have an idea, right? Now you have an idea of who really truly benefits off of payment for order flow. If Citadel can afford to pay out $1 billion in 2020, how much do you think they're making from that, right? It's a huge, massive amount of money. So here's where the two big problems lay. And this is where things get really fucky, man. I'm telling you, this is wild. Citadel accounts for 13.4% of the U.S. stock trading market as of December 2020. They control the markets. This is very similar. We're going to take you back a second here, right? This is very similar to Madoff Securities. These guys accounted for a lot of the freaking volume and liquidity that took place in the market at any given time, right? It's a monopoly. These guys literally control so much liquidity that they can move entire securities by themselves, right? Citadel has an undoubtable and an undisputable conflict of interest. And this is the second and probably most scary problem, is how much of a conflict of interest these guys actually have. I don't think people truly understand this. It's really freaking scary. Check this out. Citadel Securities, Citadel the market maker, and Citadel Connect are the three sort of entities that are embodied within Citadel itself. Citadel Connect, you might be asking yourself, what is this? It's their literal own dark pool. Now, if you don't know what a dark pool is, I recommend you go watch a video. I've got a few out there. I know there's a million of them out there in terms of what it is, but it's essentially used for two main things: executing large block trades without moving the market, and less transparency. But this is just goofy. I mean, look at this. They have their own securities, which means their own investments and their own portfolio they manage on any given day. They've also got Citadel, the market maker, which literally does exactly what this is meant to do: the payment for order flow. They trade OTC. They make money off the bid and the ask spreads. That's where they profit. They've got their own fucking dark pool, guys. They have their own shady place where they can execute large block trades for themselves, for other firms, and it gets worse than that. But wait, right? It's surely regulated. It has to be. But check this out. There's a direct quotation. Numerous reliable reports suggest Citadel Connect is indeed a dark pool. Interestingly enough, however, Citadel Connect is not registered at an ATS, which is an alternative trading system, nor does it report its trading volume to FINRA, which is overseen by the SEC. So this is a dark pool, but also has no legally binding sort of enforceable action within the actual system itself. And on top of that, these guys handle 13.4% of US stock trading market as of December 2020. They control the freaking markets, guys. I mean, it's so mind-blowingly huge how much these guys really do in the market. To put this in perspective, right? Ooh, I choked on my spit. I get too excited. To put this in perspective, if you had, let's just eyeball this and say, out of all of the United States, 350 million people, right? Let's just say that 20% of those people are invested in the stock market, at least a little bit. 20%, that's it. 35 million people-ish, whatever that means. Well, I think it's 70 million. I'm not good at math. 70 million people. You had 13% of that getting routed straight through Citadel every single day if they just bought one stock out of any security. Think about how much money that is. To take away what they do, every single American in the United States would have to quit using payment for order flow. It is embedded in every single security in the entire stock market. Everywhere you look, this is literally tied back to these guys. And what's the most scary, my friends, is that these guys are not only a monopoly, they're not only Citadel Securities, the market maker, and their own dark pool, but nobody is regulating these guys. Nobody is regulating these guys. Where's the regulation? This is so... I feel like I'm watching history happen twice. Literally. Because what happened back here, and we're going to go over this here in a little bit with Bernie Madoff and that whole sort of scandal, is he started a system, essentially, that was supposed to be the best thing since freaking jam and jelly, man. And it ended up biting him in the ass and everybody else in the future in the ass. Now, let's revisit this, right? Let's revisit the payment for order flow purpose and appeal with Bernie Madoff and evaluate the current situation so you can see exactly what I'm talking about. Bernie's firm profited off of bid and ask spreads and controlled the majority of market volume and order routing, right? That's where he made his money. They had a lot of volume and liquidity that's getting pumped into their firm. They made money off that. Ponzi scheme set aside. Bernie's firm exploited weakness in investors, albeit not using payment for order flow, but conflict of interest certainly still applies, especially considering what happened back in the day with his Ponzi scheme, with literally him tricking investors out of billions of dollars and still building payment for order flow. I mean, the guy was literally a fraudster. The guy was a fraudster, and the system is still used today. So how is that similar to now, right? Let's just connect some dots, right? You guys make your own opinions. You do what you got to do. Citadel Securities is the largest firm to execute orders and profit off of payment for order flow. We know this because of how much they pay out. And we know this also based on the fact that not only is 41% of their overall payment for order flow payments coming from Citadel, but they control 13% of the overall stock market volume just based on 2020 alone. Citadel Securities has an obvious conflict of interest, an unregulated conflict of interest. They've got Citadel Securities, they've got the market maker, and they've also got Citadel Connect. How are all three of these connected? Are they all governed by different entities? Who knows? I mean, they're not very public about the way things run. Citadel Securities also makes an ungodly amount of money off retail investors. And this is not even based on their investments. That's the thing about payment for order flow. And that's what Bernie Madoff came to realize about the stock market. If there's any synopsis I've taken away, and honestly, the more I dig into the way that this whole system is built, the more sort of disappointed I get with the way the stock market's built to keep the top on the top. People realized really quick, the best way to make money in the stock market is to make money off of other people trading. Literally, it's the most stable source of income that any big firm can make, is literally profiting on everybody's transactions. And that's the way the system's built right now. So let's evaluate the real issues here, right? Retail investors are the product, and it's unavoidable. Literally, you'd have to take every single person on planet Earth off of payment for order flow to take out one sector of what's happening in the stock market. Obviously, you do what you guys want to do, but look at the gravity of this. Look at the gravity of this. This is nuts. It's absolutely mind-blowing. The people getting paid, the brokers aren't even the problem, play the same market we do with extra information, extra liquidity, and no accountability. Now, why is this important, right? Think about this. You've got Sally over here that wants to go buy 100 shares of whatever freaking stock, and she says, yep, good to go, gets payment for order flowed up, but you've also got freaking maybe Citadel or Melvin Capital or Virtue or whoever's using payment for order flow to fill their orders at that third party, and they say, you want to buy 100 shares long on that, but we're short on this position. So maybe we're going to kind of eat you out that way and just, conflict of interest. You can see where there's problems here, right? It'd be the same as going in front of a judge and you know the jury's against you, right? That doesn't make sense. The SEC is observing this, but who's to say they won't look the other way? And I say that not to be a pessimist, but because there's actual proof of this sort of thing happening. This is coming all the way back to Bernie Madoff, the literal biggest fraudster probably in the U.S. history. I mean, it's just absurd. The OIG investigation did find, however, that the SEC received more than ample information in the form of detailed and substantive complaints over the years to warrant a thorough and comprehensive examination and or investigation of Bernie Madoff and BMIS for operating a Ponzi scheme. Despite 3 examinations and 2 investigations being conducted, a thorough and competent investigation or examination was never performed. Literally laid right out in front of us. I mean, there were people that were reporting this sort of problem for literally decades before it got cracked down on. And I literally feel like we're watching that real time right now. Like, I don't think people fully grasp the gravity of the entire system and how problematic some things in the stock market are literally freaking built. I want to leave you with one thing, right? I want to leave you with this because I think this is going to really wrap up truly what the situation is right now and where we're kind of sitting. So let me just see if this works really quick. Pull this up. There we go.
Nobel Prize in Behavioral Economics.
Nope, that ain't it. Give me 1 sec to pause this. I can probably... Oh, how do I do that? Well, I'll find it on Twitter. I retweeted it. So check this out. This is what I got. This is what I want to leave you guys with. This video right here.
Dynamics of
Give me 1 sec.
how humans behave can be, in a sense, taken advantage of by technology. If we know how humans behave and we can predict that, we can use that to better position our portfolios. And a number of quantitative strategies rely upon human biases and behavior to be successful. So as we understand this, look at the recent Nobel Prize in Behavioral Economics. As we understand this, we will use computers in new and innovative ways to better drive the pricing of assets in financial markets.
I don't think there's any better way I can put that, man. It tells you their intentions. That's what I've got for this video, my friends. I fell down the rabbit hole. Hopefully, you're able to pull some value away from that. I know it was kind of an atypical video. I know it's going to be freaking way too long, but I couldn't think of any better way to sum up what I was talking about. So, blah, blah, blah. I know it's going to drop. Like I said, friends, catch you on the next one. If you enjoyed this, you have any comments, concerns, questions, queries, drop them in the comment section. I'll try and get back to you as much as I can. But without further ado, much love for me and Titan. Titan's going freaking nuts this morning. He's a crazy chicken. Catch you on the next one. Much love and peace.